Today we're going to be doing a case study on business ownership. We're going to be taking a deep dive into entering and really analyzing the system in terms of associating business owners in RightCapital and all the different kinds of visualizations that you can utilize to ensure that we're modeling and capturing business owners accurately in the system. So we've got a lot of really great content we're going to be diving into today. So we're going to get down into it. Today, we're going to be going over just reviewing the data entry for the various business types in RightCapital. We're going to be working on that pre-retiree case study, like I said, so we're going to be doing some interesting things there. We're also going to look at capturing accurate business income and the various taxation associated with entering business income, of course, as that is going to be key when we're entering businesses, is considering that tax aspect. We're also going to look at creating and then analyzing some business proposals that we have with our pre-retiree case study that we're working on today. And of course, as always, if you have any questions throughout the presentation, please feel free to utilize that questions drop down and just input your questions there, and I'll be more than happy to engage with you guys in that way. And so switching gears into RightCapital, today we are going to be working on the Scott family, and they own a business. So we're going to start to enter that business in the profile section, and then under net worth, just some background about the family. The Michael Scott and Holly Scott family, they're currently in their mid-50s. They have 2 children. They have a current net worth of $2.09 million, including their primary home. Currently, we don't have the business entered yet, but we're going to be adding that today. But let's dive deep into the profile net worth section. And to add a business into RightCapital, we're going to click on the Add Account button, and we're going to navigate into the other section as they currently own this business. They just bought it, so we're looking to incorporate it into their financial plan. And so the first thing that we're going to want to do when we elect for the other asset class is we're going to be navigating to the asset name. We can retitle this, so that way we know which company it's for. And then the key thing is from the asset type drop down here, we can elect either if it's a lifestyle asset or a note receivable. And then you also have the option for various businesses. So we can model LLCs, partnerships, S Corp and C Corps. All of them have their own unique taxation. So it's important to make sure we're capturing the most accurate business type for those tax calculation purposes. For example, with the C Corp, that's going to be treated with business income is going to be treated as dividend income. So it's important to note specifically for business C Corps, if that is the business that a client has, we want to make sure that this is what we're electing. For this particular entry, Michael owns an LLC, so we're going to elect for an LLC. Some other entries that we're going to see here is you can include whether or not this is going to be owned by the client, Michael, or the co-client, Holly, or if it's jointly owned. In this case, it's Michael's business, so we're going to keep the owner set to Michael, but you do have those options as well. The first thing that we can address when we enter a business into RightCapital is going to be the current value of the business. And so for them, they currently have a business that's worth $1 million. Once you enter what the current value is, the next thing that we would address within this particular entry is going to be how we're going to be receiving potential income and growth from this business. Right now, for our value approach, we have simple growth selected. So what this means is that it's going to be taking what we enter for annual income, annual distribution, income growth, and annual growth. And it's just going to be a simple growth calculation from there. And so this is a good way to model a more straightforward business ownership. So if you know exactly what they're going to be receiving and it's going to be a steady growth in terms of the business and the income and distributions, that is when we can keep the simple growth option selected. In this case, let's enter some of these values over here. Let's say it grows roughly 3% each year. And the key thing for when we're entering annual income is that when we're entering annual income and annual distributions, the annual income is going to be the amount that is net of expenses that the client will be taxed on. So let's say, he's receiving $300,000 per year that he's going to be taxed on, net of expenses. What this indicates is that we're going to be seeing this as a portion of taxable income, but this is not going to appear as an inflow on the cash flows. When we go into the annual distribution field over here, this is where we indicate what is going to be received as an actual inflow in the cash flows. In this case, it's going to line up with the annual income. So it's going to be $300,000. You can also indicate if there's going to be any income growth, of course. So let's say it's going to be 1.5%. And then we can also check off if this is going to be service income. As you're going to see when we're navigating throughout this data entry, you're going to see a lot of info marks. These can be pretty helpful key insights when we're trying to enter a business into RightCapital, or just in general, an info mark is always helpful. So the service income is where you can indicate whether or not this is going to be considered from a tax standpoint a service income or a qualified business income deductible business. So with TCJA, they introduced some QBI deduction limits. So that's when you want to make sure that you're specifying whether or not it's a service income business or not. In this case, it is going to be considered service income for now. The next entry that you can address here is when the business was acquired. So you can, of course, enter that calendar year or already started. For them, they purchased it in 2021, and they have a cost basis of $750,000. So they had some growth since then. From there, we can then start to address what might be happening potentially with the sale of the business itself. So we can control when we're going to be planning on selling the business. So let's say we want to sell this at Michael's retirement specifically. So we can indicate that from the dropdown. We can even specify after number of years, a specific calendar year, or any of their other life events or specific ages. And you can also indicate if there's going to be any cost of sale reduction. So any sort of closing costs that are going to be evaluated or is going to be negotiated as a part of the sale of the business. You can also account for that reduction here. For them, it's going to be a 1% reduction. And then, of course, when you have the sale of business, how we're receiving that money is important. So you have two options here. We can either select for the sale of the business, whether it's going to be a lump sum payment. So he's going to be receiving his proceeds when he retires in that year, or if we are going to be receiving it over a series of years. So if he's agreed with the sale of the business that he's going to be receiving over the next 7 years proceeds from the business sale, that is when you elect for installment years. You can indicate that it would be over 7 years. And then you can also indicate if there's going to be any sort of interest rate associated with the installment year option. In this case, it's going to be a lump sum payment. It's a little bit more straightforward for Michael's sale of the business. But this is how you would illustrate a simple growth situation with the business. So let's hit save for now. Another key thing that I would like to note too is that you can also add a note at the very bottom. So if we click on the note section, and if we click on add notes, this is something that you can do to indicate that you are looking at the agreement. So let's say that Michael has it planned out that he is going to be selling this at his retirement. He's got that already set in his path. We can say that this is from business proposal established in 11/2023. And this can be either for your own internal record keeping, or you can share it with a client. You can mark this as just for your eyes only. By selecting this eye icon, it'll transition over to the not shared field. We can hit save. And this is just a good way for record keeping purposes of knowing that that sale option that we selected, that was specifically tied to that business proposal that Michael had set this month. And that's where we're getting that information from. Just that way we know when and where that information is stemming from. But like I said, this is a good entry for that simple growth approach. For Michael, it's not going to be so straightforward. So we're actually going to change from this value approach drop down here. Instead of using simple growth, we're actually going to elect to use the detailed schedule here. Once we elect for use detailed schedule, that is then going to populate this edit button for detailed schedule. If we click into here, this will then open up a screen in which we can start to control a little bit more and fine tune the business distributions, income, and business value. This is going to be a great option for when we have a lot of fluctuations in terms of distributions from the business and a lot of fluctuations in business value. So let's say for Michael, we have this company, it's an up-and-coming company, and we expect some major growth over the next couple of years. What this means is that we can manually enter here what we expect the business to grow from. So if we wanted to manually enter here, that we know next year there's going to be a $500,000 increase to the business value, we can start to manually control that year by year. Let's actually transition this to the 6. And the same is true for distribution. So if we have someone that's fluctuating in terms of business income or business distributions, we can also manually control the year by year breakdown of the business values and incomes and distributions. As you can see, there's a lot of years that we can manually control, and you can, of course, click into each field and enter the value that you would like to see for each year. All of what we're seeing right now is based off of what we just entered for that simple growth estimate. If we click on the quick fill option, you do have other options in terms of how we can fill in these fields. So you can, of course, apply that use simple growth, which is going to use those data entry points that we just entered to calculate exactly what we were just seeing on the screen. You can also start over. So if we clicked on clear all, that will zero out all the fields and allow us to start from scratch if needed. And then we also have the option for what is called interpolate here. What this means is that if we know that he's going to be receiving $300,000 this year, next year he's probably going to be taking a little bit less. He's going to be taking half. But we know that after that, it's going to start to steadily increase. Let's say in 2035, he's going to increase to 400,000. We can enter here that $200,000, $150,000 over here, because for him, it's going to line up for business income and business distributions in terms of cash flow and taxable income. And what that means is that right now, focusing on the $200,000 that we have entered for 2025, we have all these zeros for the next 10 years until 2035, where the income and distributions double in value. What we can do is we can use this quick fill options and then interpolate, and that will fill in those data points with a steady transition to reach that $400,000 by 2035. So that's another option that we have in terms of filling out these data entry points. So like I said, he's going to have that increase next year to 1.5 million. And then we know in 2035, it's going to be 5 million. We can use that quick fill interpolate option, and that'll populate all the fields from here. For him, he's going to be selling the business when he retires. So we don't necessarily need to fill out these extra data points, but if we're going to be illustrating him selling this at a later point in life, that's when these data points become useful to enter. But for now, we're going to keep it to just age 70. And then we're going to hit save. And so that detailed schedule can be very useful to model that situation where we have a client that is going to be fluctuating in terms of income. So whether they're going to be receiving additional distributions in one year, or if it's going to be fluctuating a lot, that's very useful. Of course, you also have that option for just the simple growth, or even the simple growth with the detailed schedule. Just allows for additional levels of control when looking to model a business entry. And so going into the retirement module, once we have that entered and properly accounted for, we're going to go into retirement analysis. And then if we go down here into the action items, this is where we can start to look at proposing a new business purchase. So in this case, Michael also has another opportunity to sell this business in a couple years and purchase a new business and invest in a new business from there. So in this instance, we're going to navigate once again to retirement analysis. And then in these action items, at the very bottom on the right-hand side, we're going to see under existing asset sales, Michael Scott's paper company. What we can do is we can change this action item to propose that he sells this business earlier on. So let's say we know that he's having this potential business arrangement in 2030 to sell this business. Let's hit refresh. And that'll apply the business sale to our business proposal over here. But not only is it going to be selling the business, he's also going to be looking at purchasing a new business. So what we can do is we can click on the edit button over here. And we're going to click on add new items. And then goals. And then asset purchase. And then business purchase. And so here we can name the business. We can enter the purchase price. So for him, it's going to be 2.5 million. The owner is going to be Michael. And then you can also enter, similar to that profile net worth entry, the business type. So whether it's going to be an LLC, a partnership, an S Corp, or a C Corp. This instance is also going to be an LLC. And we're going to specify for year 2031 because it's going to take some time to transition from the existing business into this new business. And then we can also enter similar data entry to what we entered before. So let's say this is going to be a little bit more of an aggressive growth. For this one, he's going to have some additional opportunities. And so we're going to see some annual income and some annual distributions. But the growth is going to be less aggressive. And then the key thing too is when we're doing a business purchase of any sort is that you can indicate whether or not we're going to be purchasing this and financing this purchase, or if we're going to be purchasing this and it's going to be a full cost up front. So in this instance, we're going to pay the full cost up front. So we're going to enter a down payment of 100%. But if he was financing this purchase, you can enter the term, what the down payment would be, and also the loan rate. And then you can also indicate if he plans on paying off that financed loan that he's taking out early, or if he's going to follow the normal schedule for payoff. But this is only relevant, this early payoff, for if he's going to be taking out a loan to pay for this business. And then similarly, we can also enter if this is going to be sold at a specific time frame. So if it's going to be his end of plan, or a specific year after a number of years, or a specific life event. In this instance, we are going to plan on selling it at Michael's retirement. Cost of sale, there's going to be no cost of sale for this particular option. And for sales option, we're going to keep it to lump sum. And then we're going to hit save. And that is how we can propose that new business purchase. And then we can see this comparison between our current plan, which is going to have the existing business, the Michael Scott Paper Company is going to be incorporated here. And then we're going to have our business proposal of the Dunder Mifflin that he has the opportunity to sell his existing business and purchase a new investment into this Dunder Mifflin business. Another key thing to consider, and this is already a great question that I'm seeing in the questions. So when we have somebody that owns a business and they're receiving distributions from the company, there's going to be multiple routes that are happening in terms of income. So if we have somebody that's just receiving distributions, that's when the profile net worth entry or your business entry itself is a great place to capture those. But what do we do when you have somebody that's also receiving separately just a standard W-2 salary as they're also working with the company? So that's when we go to profile income, and we're going to utilize the salary income card to model that W-2 salary. And this is going to be subject to all the W-2 salary taxes that are applicable, and it's just going to be considered a standard salary. When we're looking at modeling those business incomes from LLCs, partnerships, and S corps, those are going to be business income that's taxed as ordinary income, and they're going to appear on their corresponding lines on their various schedules. But this W-2 salary is relevant for when we have somebody that's receiving separately a salary from the business. In this instance, Michael is receiving a salary on top of also receiving various distributions over the years that he's going to be owning the business. So we would maintain both entries, but we want to make sure that if we're entering this salary income here, this $125,000 that he's receiving until retirement, that's not also going to be incorporated in any sort of income that we're entering here, because that's already going to be captured accurately in the income entry card itself, back under profile income. So this business entry is where we indicate those additional distributions that are going to be different, and they're going to be taxed accurately based off of what we enter for the business type. So it's a good question and a great point. And then, of course, under profile savings, since we have that salary entered, and that's also where we're going to see some contributions going towards, if we go to the 401k card, this is where we go to model those 401k savings that he's making towards his traditional 401k. And we would just enter this as is. You do have the option to elect for self-employed. But one thing that I want to note is that if we have somebody that's receiving separately self-employment income, that's going to be added under profile income under add income self-employment. And this is going to be taxed separately. And this is a separate entry. And once again, everything you're entering here under profile income is going to be separate and on top of any sort of income distributions they're receiving from a business. So you have all different options to model business income and also potential salaries or potential side self-employment income that a client's receiving. And so back in retirement analysis, this is where we can go to see that sort of side-by-side comparison between our current existing business and the sale of our existing business versus purchasing the new one. A key thing that we can see here, besides just the difference in ending asset values from the 1,000 trials of market volatility, is even more importantly, we can view under here the comparisons visualization. And so under comparisons, this is where we can see a strong analysis of the difference between our current plan and our business proposal. And we can see here the difference between their invested assets. As we can see, the business proposal has less assets than the current plan. We can also view the difference in net worth. We can also view the difference between taxes that are paid over time between the two scenarios. And we can also view the difference of assets at retirement between the two scenarios as well. So as we can see, potentially the business proposal, as their income's not growing and the business value isn't growing as substantially as the current plan scenario, looks like they're going to have less in assets versus if they followed the current plan. But it's a good place to view that kind of side-by-side comparison and also see this chart that analyzes the difference between the very important conversation of how much more am I going to be paying in taxes for my proposal versus not.